Welcome to Adda 24/7. We are in a summary session for BFM Module A. Summary means what? We are covering all the topics, important topics, which are covered up till now in YouTube since last 1 month. Last 1 month we are focusing on Module A of BFM. Means Module A means foreign exchange, pre-shipment, post-shipment, then the Reserve Bank, then ECGC. We have covered all those topics. So today we'll be focusing on the main summarized topics of those. Now see here, everything won't be covered. That's a but obvious. But main summary part means what we'll be focusing on? Main theory, and second is MCQ questions. MCQ questions, which will be told to you, they are so important from the exam point of view that 1 mark questions, you get around 50 questions in the exam, 50 to 60 1 mark questions. So these may come over there. So that's why follow the video till the end, everyone. Okay, let's start. Firstly, those who don't know, remember in a fast, I'll just cover these 4 subjects compulsory: ABM, BFM, ABFM, BRBL. No negative marking now. So this has been removed. Let me remove this. So as of now, IIBF has told no negative marking. Then there is a subjective question in which no ABCD options will be given to you. No options. Okay. So no options given to you. Only you have to input the question answers in that screen which is given to you, and in that using the virtual keypad. Okay. Then electives, 5 electives: rural, HR, IT, central banking, race. You have to select one of them. These all the 4 papers are compulsory. Okay. So this much you might be knowing by now. So let's start with the topic. First, we are focusing on the theory of exchange rates. Okay? Exchange rate movements affect the nation's trading relationships with the other nations. Now, what do you mean by this? Here, exchange rate movements affect the nation's trading relationships. Whatever we trade, okay, means India's forex reserves. They are always the main part of any international trade transaction. For example, right now, what are the India's forex trade? Around they are almost $500 billion roughly. Yeah. So they are enough for us to cover for the remaining 11 to 12 months of oil. Importantly, remember, as per this World Bank, what do we consider as the best foreign reserves? We consider as best foreign reserves when the foreign reserves are enough to cover the next 9 months. So here we have 11 months, and these figures are almost 2 months back. So latest figures will be much more. So exchange rates affect the nation's trading relationship with other nations. Similarly, you can watch the neighboring countries of us, as Pakistan, Sri Lanka, gone. Because why? No forex reserves, right? Because if you have the huge forex reserves, you can deal with the other countries with strong hand. Okay. A higher valued currency makes a currency's import less expensive and its export more expensive. What do you mean by this? Now, this is a big statement from the BFM point of view. A higher valued currency makes the country's imports less expensive and its exports more expensive. Exports more expensive. Higher valued currency means what? What do you mean by higher valued currency? Suppose if I say $1 equals to, let's say, 80 rupees. Okay. Now, can I say it's a higher valued currency? No. Don't confuse these things. Here you can't say higher valued or lower valued. Now, the higher or lower valued will come to know when it moves. Suppose if this 80 moves to 50, let's say it moves to 50. So $1 equals to 50 rupees. Let's say it happens someday. Then this is known as rupees higher valued. Okay, then it becomes higher valued. Okay, means what is happening? For $1, I was paying 80 rupees earlier. Now I'm paying only 50 rupees. Now in this, what will happen? Look at both the situations. When I'll make the exports, let's say I make the export of $1 only. Let's say only $1 I make the export. So when the rupee was 80, for $1, I was getting 80 rupees for that $1, and now I am doing the export of $1 only, and I am getting only 50 rupees. So what has happened? exports become more expensive. I'm getting lesser money in exports. Similarly, reverse is the import case. Suppose if I'm purchasing something from, let's say, UK, US, anyone. So let's say I'm making a purchase import of $1. So for that $1, I had to pay 80 rupees earlier. But now how much am I paying? 50 rupees. So what has happened? Rupee has appreciated. Rupee has appreciated. So what do you mean by this? Appreciate. Okay. What do you mean by this? It means whenever the currency rupee appreciates, who depreciates? Remember, it's a zero-sum game. Always remember, this is known as a zero-sum game. Zero-sum game means what? If somebody profits, somebody else loses. So in this case, what has happened? Suppose if rupee has appreciated, who has depreciated? It is a dollar who has depreciated. So dollar has depreciated. Okay, depreciated. So this is known as depreciation. Or in our BFM terms, you can call it in a different perspective also. Rupee is in a premium. This is known as premium. Now you'll understand all the concepts over here. Rupee is in a premium, whereas dollar is in a discount, right? So understand this point. Rupee is in a premium, dollar is in a discount. So higher valued currency makes the imports less expensive, whereas exports more expensive, because we get lesser money for exports and we have to pay less money for imports. Okay. Now, a lower valued currency makes the country's imports more expensive and its export less expensive in foreign markets. Now, this is simple to understand, isn't it? Means as you have understood the first term, the second term is just vice versa. Okay, I'll write it over here as vice versa. That's it. Of the above case, nothing else. Okay, so we won't waste our time. A higher exchange rate can be expected to worsen a country's balance of trade, while the lower exchange rate can be expected to improve it. What do you mean by this? Higher exchange rate can be expected to worsen the country's exchange rate, the country's balance of trade. Means what? What do you mean by this? A higher exchange rate means, same example, we'll take it again. $1 equals to 80 versus $1 equals to 50. Okay. So higher exchange rate means what? From 50 it goes to 80. So higher exchange rate. This is higher. So it will worsen country's balance of trade. Obviously it will worsen. Why? Because if I am making the imports, right, I have to pay how much? I have to pay 80 rupees for $1. So my money is gone. Okay. Similarly, if I am making the export, so I am getting this amount I am getting higher over here. But always remember, in developing countries like India, we are import-oriented economy. So $1, as the dollar appreciates or rupee depreciates here, 50 to 80, it means rupee is depreciating. So higher exchange rate means rupee is depreciating. So when the rupee is depreciating, it can be expected to worsen country's balance of trade. Obviously, balance of trade will be affected. What is balance of trade? There are two things. Okay. One is balance of payment, BOT, I'll write it. Okay, trade first and then balance of payment, BOP. Okay, so these are the two things. What is BOT and what is BOP? BOT means, okay, BOT means import and export. Import and plus export, both. Here, plus means what? It is actually the combination. Suppose if I make the export, I'll get the money. If I make the import, I lose the money. Simple. So in this case, what happens? It is actually BOT will be, simple formula over here will be E minus I. E minus I. Export minus import. Right? This is the basic formula for your balance of trade. What is BOP? BOP includes other things other than the export and import. Means NRI transferring the funds, or this FII investing, FDI investing, all these come under BOP. Okay. It also includes BOT. Remember, BOT is net balance is always transferred to BOP. Okay. So the higher exchange rate will worsen country's balance of trade. So obviously, suppose if I am having the higher exchange rate, it means what? If I am having 50 to 80, it goes. It means what? My imports have become this means for importing $1, I was paying 50 rupees earlier. Now I am paying 80 rupees. So I'm paying higher rupees. So my currency depreciates over here. So my balance of trade will be worsened. I'll have less money with me then, right? And reverse is also true. Lower exchange rate is expected to improve it. Aside from the factors such as interest rate and inflation, current country's exchange rate is one of the most important determinants of country's relative level of economic health. Remember, three things are always important. One is interest rate and inflation, and the next part is exchange rate. Remember, interest rate and inflation, they are always related to each other. How they are related? Even exchange rate is related to it, but it is a secondary part. Primary, these two are related. How they are related? Let me show you. Suppose if interest rate is high, interest rate means what? What do you mean by this term interest rate? It is any benchmark rate. Now, which is that benchmark rate? Let me consider one. Let's say repo. Okay, I'm having repo rate over here. So if my repo rate is high, it means my interest rate is high. What will happen? Because of this, banks will increase their loan rate. See here, loan rate. Okay, that will be increased. So because of this, what will happen? If loan rate is increased, then banks will give lesser loans. Here, it affects banks give lesser loan. Banks give less loan. Because why? Rate is high. Nobody is going to take the loan. So banks give less loan. Due to this, what happens? People have less money in their pocket. People have less money because loans are less. Because here, the entire economy of any country works on the loans only. Whether you might feel that we are dealing in cash, but we are not actually dealing in cash. The entire economy is RBI's credit and monetary policy. That policy is very important. So RBI gives less, so people have less. So as people have less, inflation goes down. Inflation, it will go down. Always remember this. If repo rate is up or any benchmark rate is up, the loan rate is up, banks will give less money, people will have less money, and due to this, inflation will be down. Right? So this is the basic tool. Okay. Do you know in USA what was the inflation rate? Almost in 3-4 months back in December, it was around 9.5%. In UK, it was 13%. Now this inflation has come down to around 3.5 to 4% in US. Because of this interest rates, their Federal Reserve increased the interest rates like anything. Okay. So coming back, interest rate and inflation are related, and also the currency exchange rate is one of the important determinants. Now, what do you mean by this? See here, if the interest rates of any country go up, the currency becomes stronger. Always remember this. Repo rate goes up, then rupee will become stronger. Rupee will become stronger. Okay, rupee will be stronger. So rupee will be stronger means dollar will be down. Okay. Same thing happened with US also. US increased their repo rate there. So because of that, what happened? The dollar went up. The rate of the dollar, if you check from last December to now, just check on Google right now. Right now you check it. The value of the dollar went up. Why? Because the interest rates increased. From means it was increasing up to December. Means last year full the US was increasing the interest rates. So the dollar was up. Okay. Now they are decreasing the interest rate. So the dollar will come down now. Okay. Coming back. So aside from interest rate and inflation, the exchange rate is also one of the important determinants. Okay. A higher valued currency makes the country's imports less expensive. Now this you know already. Export makes more, its export more expensive in foreign market. Done already. Okay. Move on. Exchange rates are relative and are expressed as a comparison of currency of two countries. Of course, what is exchange? You go to any sabji mandi, you go to any vegetable shop. What do? It's an exchange. You take vegetables, you give that money, cash, isn't it? Same logic happens everywhere in the world. You take money, you take dollar, you give rupees, right? If dollar is expensive, it means what? I'll give higher rupees. Simple, isn't it? Everyone, before going ahead, download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material, plus live classes, ebooks, test, everything you will be getting. So download it right now. See here, you all are here for clearing CAIIB, right? So what do you need for clearing CAIIB? Tell me. What do you need? Number one, you need lecture. lecture, video lecture. We give you a video lectures over here. See, physical lectures, it's out of the question nowadays. That world is gone. Physical classes, world is gone. Since COVID, everyone is going for online. Because if I go on taking physical lectures, then how far can I reach in India? Online, you can reach anywhere. So that's why we have video lectures over here. Secondly, what do you have? What do you require? You require books. So we have ebooks over here. Ebooks, right? Then third, what do you require? You require to check your knowledge, test your knowledge. For that we have tests. So you have tests over here. So all the three things which are required for clearing any exam, they are there. So immediately what you do, you download this app and start reading. Okay, go through it, isn't it? Okay. Now determinants of exchange rate. How are the exchange rates determined? Numerous factors determine the exchange rates. Many of these factors are related to the trading relationship between the two countries. Obviously, trading relationship. How is the currency between the two countries is faring with each other? It depends on that. Okay, means trading relationship of ours with US is different. Then ours with UK is different. Then with Pakistan it's different. You'll say Pakistan is an enemy nation. We are still doing around 21% of the trade with Pakistan. Last week's figure. Okay. So, of course, we are in a dominating position. That's a separate aspect. So, exchange rates are relative and are expressed as a comparison of currencies of the two countries. Now, we have already studied this. Okay. The following are some of the principal determinants of exchange rate between the two countries. Note that these factors are in no particular order. So the factors which are given are not in any particular order. Okay. Like many aspects of economics, relative importance of these factors is subject to much debate. Okay. Now what are these factors? Let's look at this. Differentials in inflation means inflation rate difference. Means what do you mean by inflation? Mehengai. In Hindi we call it mehengai, right? So inflation rate difference. Typically, a country with consistently lower inflation exhibits rising currency value as its purchasing power increases relative to the other currencies. Isn't it true? Okay, let me ask you the question. In USA, what is the inflation rate roughly? Now it was higher. As I told you earlier, last year it was 9.5%. But generally, what is the inflation rate? Generally, USA has an inflation rate of around not more than 1.5%. What is the inflation rate in India? Generally, I am not saying this, generally it is, means CPI we call it, Consumer Price Index. So, that is around what? That is around, I'll tell you, 4.5 to 5%, roughly, 4.5 to 5. Okay, let's take 4.5. So, what does this statement do? Say, a country with consistently lower inflation exhibits rising currency value. So, isn't dollar stronger? Who is stronger over here? Is dollar stronger or is rupee stronger? Dollar is stronger. Why? Because they have lesser inflation. Rupee is weaker because in comparison to US here, weaker means what? We are weaker in comparison to US because the inflation is high over here. This inflation, when it comes down to 1.5% in India also, will definitely have this rupee stronger. And we are moving towards it. Remember, there was a time when Indian inflation was 9%, 11% for almost 1 year, 2 years, constantly 9% and 11%. What is the inflation rate in Pakistan right now? More than 30%. Inflation rate in Sri Lanka more than 30-35%. Gone. Everything is gone. If your inflation rate goes more than 15%, imagine, say your country is going down. You check out Zimbabwe, Venezuela, these countries gone because the inflation rates are around in thousands. So difference in inflation will always cause the difference. The country with lower inflation will always have a stronger currency. Okay. Differential in interest rate, same logic again. Interest rates, inflation, exchange rates are all highly correlated. By manipulating the interest rate, central banks exert influence on both inflation and exchange rates. Changing interest rates impact inflation and currency values. Now, manipulating interest rate means what? See here, it manipulating word means it doesn't mean central bank does it forcefully. If tomorrow RBI says we will increase our repo rate, nothing doing. Why? Because we say we want to increase it. No, it's never like that. RBI can never increase the repo rate without thinking or without doing any calculations. So this is basically based on that ISLM curve. This is known as IS curve, investment saving. Investment savings. Now those who are from the old portion, you have studied this in the old portion economics. You had this topic in your ABM. Okay, investment saving, and second one was this LM, right? Liquidity preference money supply. Liquidity preference. Here, all these things are related to each other. Remember, you can't say that I'm studying Forex, so I won't pay any attention to anything like this. Preference money supply. Okay, LM. So, where it matches with each other, at that rate only RBI fixes this repo rate. This is always related to R over here, and this is the time horizon. Okay, so by manipulating the interest rates, manipulating means changing. This word is not correct actually, it should be changing. Manipulation means doing it forcefully, some wrong thing, that is called as manipulation. So, by changing the interest rates, the central banks exert influence over the inflation and exchange rate. So, if the interest rates are higher, as I told you earlier, inflation becomes lesser, currency becomes stronger, isn't it? Current account deficit. The current account deficit is a balance of trade between the country and its trading partners. Now remember, when we say the current account deficit in India is so much, whatever we say. So always remember, current account deficit will be different for each country. Means, suppose if India is trading with US and India is trading with China. So the current account deficit will be different for India-US relationship and different for India-China relationship. So current account deficit is not a single word or a single term for all the countries. No. Every country, some countries we have high current account deficit, some countries will have lower current account deficits. In China, we had, I'll tell you one story of China. In China, India-China relationship, before this 2014-15, okay, we had almost 70% imports. Not even 70, it was 73% imports. And only remaining, whatever that 25-27% exports, only that much. And that also what we exported, some basic goods of what, this food grains and everything. Now, present situation, what is the situation? What are the imports from China? We have decreased them up to 21%, 21-22%. So the imports from China have decreased drastically. Make in India, huge difference. Make in India has made a huge difference over here. Okay. So that's why current account balance, current account is the balance of trade between the country and its trading partners, reflecting all payments between the countries for goods, services, interest and dividends, isn't it? Okay. Public debt. Public debt means, what do you mean by this word public debts? Countries will engage in large-scale deficit financing to pay for public sector projects and governmental funding. So, two things are there, public sector projects and governmental funding. Now, governmental funding means what? Getting money from the government. Okay. And large-scale deficit financing to pay for. Large-scale deficit financing means what? Suppose government requires huge construction for roads, highways. What are we doing? We are presently doing what? We are doing all that. National highways are being built. Then what? Expressways are being built, right? Then Samruddhi highway in Maharashtra, it's being built. All these things means 120 speed we are going on. Okay, everywhere we are building the similar roads. Railway network is increasing. Airport network is increasing. So where do we get money from? Government requires money for this, right? So there can be various ways of financing this. Number one way what government is doing is PPP financing, public partnership, right? Public and private partnership. So that is one way out. Or second way out is taking the loans. Government also issues the bonds and takes the loans via RBI. What does RBI do? RBI is a banker to the government. So what does RBI do? RBI on behalf of the government issues the bonds. And those bonds are purchased by others and then the money is given to you. Isn't it? That is the way. So countries will engage in large-scale deficit financing to pay for public sector projects and governmental fundings. There is one more third way out here. Two ways I told you. One is PPP, second is bonds. Both these are risk-free. Risk-free means what? Suppose if I get the bonds, so basically I have to pay for those. But there is also a third component, that is known as loan, direct loan. No bonds, nothing. Sir, please give me money to IMF. Sir, please give me money to World Bank. Sir, please give me money to USA. That is third way. But India doesn't follow that way now. India goes for the market ways, bonds and PPP. No, sir, gone are the days. Okay. While such activity stimulates the domestic economy, nations with high public deficits and debts are less attractive to foreign investors. So everyone who is having high deficit and debts are less attractive, but there is an exception to this. Remember, this sentence is not true for USA. Not true. Why? Because if you see, USA is having double the debt than its economy size. Double the debt. Then is it less attractive? No, it is more attractive. Why? The only exception to US is because their currency, dollar, is used as a base currency throughout the world. The day this changes, this dollar changes from base currency and it becomes a individual currency of US. Presently what is happening, USA prints the dollars and sends it throughout the world. The day this printing of dollars stops and it's getting spread to the world stops, at that time this rule will apply to USA also. So always remember, other than USA, nations with large public deficits and debts are less attractive. Pakistan, Sri Lanka, same, isn't it? Whenever you want to look at any fiasco situation, fiasco means any problematic situation, look at these two countries. Pakistan, Sri Lanka, simplest countries to remember. Okay. Strong economic performance. The foreign country investors inevitably seek are stable countries with strong economic performance in which to invest their capital. Now, what do I mean by this? Suppose if I tell you, let me ask you only. Suppose if I tell you tomorrow to invest in Pakistan, set up an industry or buy the shares of Pakistan company some. Invest in Pakistan. Will you invest? Pakistan. I'll tell you to invest in Pakistan. Will you invest? No. Suppose if I tell you to invest in Sri Lanka. Will you invest? No. Suppose if I tell you to invest in USA. Will you invest? Yes. Why? Because strong economic performance. I tell you to invest in India. Yes. Strong economic performance. 6.5% GDP presently, right? 6.5 roughly. I'm telling lesser. It's around 6.75 to 7. Okay. So, and even expected GDP for India is around 7%. India is expected to grow at around 11 to 12% from 2025, next 2 years from now. So, strong economic performance in which to invest the economy. Everyone wants the running train. Keep it always simple. Everyone wants to invest in the running train. Nobody wants to invest in the stop train. Will you board a stop bus? Suppose if you have two buses, you have to go somewhere. You have two buses. One bus will be leaving after half an hour. Second bus is leaving immediately. Which bus will you travel? You will obviously travel that train, that bus which is immediately leaving, right? So everybody wants to board the running train. Okay. The country with such positive attributes will draw investments, funds away from other countries perceived to have more political and economic risk, right? Means USA and India will always draw more FDI and FPI than Pakistan, Sri Lanka and that third country Afghanistan, isn't it? You consider any country, Pakistan, Sri Lanka, Nepal, Afghanistan, all these are same. Okay. Now everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, number one, you will be getting the free YouTube series, free YouTube series on all the subjects of JIB and CIB, all. Okay. So you'll get this free YouTube series, number one. Number two, I would suggest you to go through the best thing you get is latest updates on JIB and CIB. From IIBF, whatever are the latest updates, number one, updates, you immediately get it on the Officers Adda 24/7 YouTube channel. And second is free YT series. See here, whatever is free, you should grab it fast, isn't it? What should we always try to do? Grab something which is free. So click on this bell icon, click on the subscription button and done. Let's go to questions now. The decrease in the value of the foreign exchange rate, which is done intentionally by the government, is called as. Now you will have two different words and I'll give you the definition or meaning of these two words. The decrease in the value of the foreign exchange rate, which is done intentionally by the government. Here, there are two ways of currency going up or going down. One is by the government, that is known as forced. And second is by the market. Means somebody interfering in this, that is known as force, and second is in the market. Okay. This is what called again, that there's one big problem which has been done in your CAIIB studies. Earlier you had the economy part, ABM, module A, you had that economy part, very good part. Now that has been removed. I think so it has been brought to JIB now. Okay, JIB, IEIFS, Indian Economy and Financial Services. But then also, in that also, that is not that much detailed. But here you had two detailed subjects and it was good one, module A. This is known as command economy, command, China. China has a command economy, China. Their government always interferes in the exchange rates, always. Okay. And market economy means free. We call it this market economy only. And it is known as free economy or capitalist economy. Capitalist, right? So capitalist economy. India is a market economy. India is a mix, in fact, somewhere, but mostly now 95% we are a market economy. 5% only India somewhere interferes. But that is a common thing in every country. Even US is the market economy, but the government still has the power of 5%. Everywhere, after all, the government will keep it. Okay. So whenever it is done intentionally by the government under this regime, this is known as what? Appreciation, depreciation, devaluation, revaluation. See here, R decrease in the value, the currency value is decreased. So this is known as devaluation. Remember, these two words are for this forced economy and these two words are for this market economy. Always remember this. Appreciation, depreciation is by the market economy. Devaluation, revaluation is done by the forced economy. Okay. Which of the following is not correct in value of the domestic currency? Not correct. Okay. Not correct. We want not means we want false. Okay. What is false? Let's see. Devaluation is done by the government. So will government do it? Yes. Government means what? Revaluation and devaluation. Revaluation is done by the market fluctuations. Appreciation is done by the change in the demand and supply of the foreign exchange. Now what is this? And none of the above. So which of them is not true? See, devaluation is done by the government. True. What did I tell you? Two words. Revaluation and devaluation are done by the government. But what is said in B? Revaluation is done by the market fluctuations. No. Market fluctuations don't do revaluation. They do appreciation and depreciation. So this is false. So this is my answer. Appreciation is done by the change in demand and supply, market forces. Similarly, depreciation is done by the change in market forces. Simple, isn't it? Which of the following is correct now? Now we want true. Always focus on what you want, true or false. Otherwise, you'll know everything and you'll make a mistake. Which of the following is correct now? Depreciation in the value of the domestic currency is caused because of the fluctuations in the demand and supply. See this word again. Depreciation. Depreciation means market forces. So is it correct? Fluctuations in the demand and supply, market forces. So true. You've got this answer true over here. Let me see what is B. Devaluation in the value of the domestic currency is done intentionally by the government. So this is also true. Devaluation and revaluation by the government, isn't it? Appreciation is done intentionally by the government. Appreciation, this is the market word. So this is false. So this is true. So what is the answer? A and B. Both A and B are true, isn't it? Clear? Everyone got this? Type yes in the comment section. Has everyone got this? Type yes. Okay, clear? Clear? Move. Which of the following rates will be applied before applying TT? Which of the following rates will be applied before applying TT? Okay, for let's say I'll extend this question. Before applying TT for exports, I'll say exports. We'll extend this question because there should be clarity in this. So which of the following rates will be applied before applying TT for exports? So remember two things. There are always, basically in this forex market, there are 4 to 5 rates. Okay, there are 4 to 5 rates. Which are those 4 to 5 rates? One is TT, telegraphic transfer. Second is bill rate, means risk related rate. If I am financing something, doing something for the future date, that is bill rate. Next is cash rate. Cash means currency. If I am having cash dollars, so that is cash rate is different. Then there is TC rate, traveler's checks rate, TC. This is separate rate. Suppose if somebody brings TCs, then the rate is different. Okay, so these are the 4 main rates used in the international world. But when you do international trade, I'll tell you simple, cash and TC are not there in existence. Because have you seen any international export being done in cash? If it is done in cash, then majorly it becomes hawala, right? Illegal transaction. Generally, whatever international trade happens, the funds are transferred either through bank, right? So what rates are applied? Only TT or bill. What is bill? A future related risk. Whenever I am applying any risk, then I am taking the bill rate. Whenever no risk, then I am applying this TT rate. And always one more point, for exports, we always, here I'll write it over here. For exports, we always take buy rate. Buy. Remember this. Export is always buy, and imports, we always take sell rate. Sell. So export is always buy, import is always sell. So what is the question over here? Which of the following rates will be applied before applying TT for export? So TT, so bill is out, TT buying, TT selling. So export, buy. So answer is A. Okay. What is the amount of post-shipment finance to the exporter? Very important. Post-shipment finance. What is the amount of post-shipment given? Percentage you can say. What is the percentage amount of post-shipment finance? So always remember. Okay, let me check the answer from your side. I'll take 2 answers now from you. One is pre-shipment finance. Pre-shipment. What is pre-shipment? Pre-shipment means this amount is given when you get the order before shipping the goods. It is given for manufacturing. And second is post-shipment. Okay. So what is post-shipment? After shipment is done. Let me show you. Do you want to see this? Okay, let me show you this. See this. This is my, suppose I get the order. This is what I am the customer. Okay. I get the order from this, order from the buyer or importer, I'll call it. Importer gives me the order. I am the exporter in India. I got the order. Okay. Order. So I don't have money to this manufacture those goods. Let's say he has given me the order for 1 lakh chairs. 1 lakh chairs. Okay. Chairs. Okay. So I have to prepare these 1 lakh chairs, but I don't have money. So what will I do? I am the exporter. I'll go to the bank and tell them, sir, I don't have money. Kindly give me the money. So this money given by the bank for manufacturing these chairs is known as pre-shipment finance. Okay, this is known as pre. What will happen? I'll manufacture those chairs and then I'll send it via this ship, right? Generally it is sent through ship only. It can be sent through air also, truck also, anything, depending on the distance of that country and the easiest communication mode. Okay, so I'll send it via ship. So this pre-shipment, where does it end? It ends by when I load the goods on the ship. When I load these goods on the ship, my pre-shipment ends, and from here post-shipment starts. Here it is post-shipment, post. So this will go to this importer again, or here, importer, right? So it will go to the importer. Okay, simple. So this is post and this is pre. So what is the percentage of pre-shipment? Always remember, pre-shipment is always given generally 75 to 80% generally. Okay. And what is post-shipment? Post-shipment is always given 100%. Always. Post shipment is always given 100%. There is no way out. Okay. So clear this term. What is buy low and sell high maxim? Now this maxim is used in Forex. What do you mean by this? See here. Why this Forex? Forget this Forex. If you go to a vegetable vendor, always compare this Forex rate with vegetables. Okay. When you go to the vegetable vendor, sabji wala, what do you say? What do you say? धनिया कैसे दिया? Potatoes, batate, this आलू कैसे दिए? Right? Aloo rate, suppose if he says 40 rupees per kg, what will he say? Sir, 40 बहुत ज़्यादा है, थोड़ा कम करो. वहाँ बाजू वाला तो कितने में दे रहा है? 35, 30 में. So you'll agree to bringing down the rate. From 40, you'll bring it down to 35. So what are you doing actually? You are buying low. So same is used in every business. Why only Forex? Every business you are following the same rule. You should buy low. Okay, so buy low means what? You'll always try to reduce the rate and sell at a higher rate. But how to compare this? For comparing this, here it's like this. I'll give you a simple rule over here. Okay. Whenever we are doing any transaction in between a month, let's say January only, we'll take it. Simple. January. So if I am doing the transaction on 10th of January, 10th Jan. So which rate should I take on 10th of January? See here, this is January start, Jan 1, and this is Jan end 31, right? So what will I do? I'll take both the rates of buying and selling. Suppose if I am having buying rate, let me write it over here, buy, and I'll write it over here, sell. So I'll take the month January 1st rate for buy, whatever it is. Okay, that rate I'll take it over here, and from here, let's say it is 40 dollar rate only. Let's say this is 80. Okay, and this 31, the rate is, let's say, 82 for $1. 82 rupees for this, rupees for $1, and here 82 rupees for $1 for January end. So what will I do? I'll buy low. If I have to buy the currency, if I am the bank, I have to buy, I'll buy at 80. And if the currency is to be sold to that customer, means it's an import transaction, so I have to sell that currency, then I'll take 82. I'll take this rate. So that is the meaning, buy low and sell high. Always we use the same maxim. Okay. So remember this term, buy low, sell high means we'll always buy at a lower rate and sell at a higher rate. Always. This is a basic rule which is followed. Okay. So never forget this concept over here, because in exam you'll get so many numericals for this. Okay. And that's why I'm saying, see here, in a 1 day's class or summary class, it's not possible to cover all the things. So that's why I'm telling you, join the batches. Okay. Sankalp batch just now started. All the 4 compulsory subjects are covered, numericals, objective questions, case studies, everything is covered. You can join the Mahapack. What do you get in Mahapack? Remember, live classes, video courses, e-books, tests, mini and mega marathons, practice papers, doubt sessions, everything you get it. So that's why you join these immediately, because exams are so near. How to join this? Let me show you. Go to Adda 24/7. Okay. Let me take you to Adda 24/7. I always suggest you to go through the app. Always remember. Because in the app, you will be getting 1%, generally 1% extra. Why 1% extra? Because there is a coin system. Yeah, when you go on making the purchases on Adda 24/7, you get coins. Those coins are helpful to you in getting the discounts. Okay. So go to Adda 24/7. This. Now you are on Adda 24/7 here. So go to JIB and CIB. Click on this JIB, CIB, JIB October and CIB October, November. You wanted CIB, right? Click on this. Then CIB Sankalpa batch. Look at this, 24th. Done. Look at the details. All the details are given. Recorded session, limited size batch, interactive classes. Importantly, recorded sessions. Remember this. Because of this, what happens? Recorded sessions. If you miss out on any class someday, you will definitely get back to it. Okay. Click on buy now. See this, apply the code. See here, job 75 and job 15. Okay. One more code, let me show you. See here, already it is 80% is applied to you. So once 80% is applied to you, you need not apply any code now. Even if you apply any code, it can't be more than 80%. 80% off is not a joke, isn't it? 23,999 reduces to 4,799. Huge discount. Go for it. You can buy the Mahapack also. Mahapack, as I told you, multiple batches you get. Multiple batches per subject, per topic. So multiple batches means what? Those many times you get the revision. Suppose if you attend 10 batches. So 10 times you are getting the revision of ABM. So is there any further need of reading any book then? No. Go for CAIIB Mahapack. Look at this, double validity. So this code JC already applied. JC80 code is already applied. Click on this, buy now. Look at this, double validity, 24 months. Buy it immediately. What are you waiting for? Double validity, 24 months, 80% off. This discount is also there. Double validity is also there. Then what do you require? And this is an investment for lifetime. Once you clear CAIIB, in how many months will you recover this 10,314? How many months? Hardly 10, 11 months. That's it. So do it immediately. Okay. Buy it and go to the batches and join it. Start studying immediately. I'll be back tomorrow with another series. Till then, goodbye and keep studying. Okay.